All right, guys. It looks like we are live. A little bit late on the draw here. Normally try and get these started before the market actually closes. Market is closed now, but go ahead and start throwing in any questions you have for me in the chat. Also, happy New Year's Eve. This is last day of the year, and you know sometimes years end with a bang, and sometimes years end with a sputter. The S&P 500 is down 75 basis points, 0.75% today. The Nasdaq is down 0.66%, Dow is down 0.63%, and the Russell 2000 down 0.75%. So not exactly not exactly a big green candle to end out the year, but that's okay. Let me pin a comment real quick. Just so you guys know, I will be answering as many questions as I can. Feel free to chat with each other. I know that's something that is very common on live streams. Just know that I will be kind of trying to find comments that are tagging me at Heresy Financial to look for the questions. So if you do have something that you would like my insight on or my answer on, go ahead and just tag me on that comment. That way, I'll have a better chance of being able to see it because I know there's lots of other comments going in there that are not necessarily for me. Okay, silver prediction, please. I have a deep dive video coming out tomorrow morning on silver. I know that it's probably a little bit late. This video probably, if I could have gotten it out earlier, I would have. It looks like the blow off top and the pop of at least a short term bubble has happened. Don't get me wrong, I am long term bullish on silver. I think this current rally though has been overextended a lot. And a lot of speculation, leverage, short squeeze, all of that. And so short term, I am bearish. So I do have a near term put option position on silver, but that doesn't change my long term holdings. So that I want to be clear, there's a difference between your long term holdings, your long term portfolio, and then your trading account. So got a short term short on put or on silver, but that doesn't have anything to do with my long term positioning. Why is palladium taking a big hit? The metals across the board, you've kind of seen a similar pattern. Like if you look at platinum as well, very similar chart pattern, price pattern that you've seen out of silver, even gold as well, although not to the same extent. Gold is a lot less of a volatile metal because it's more of a monetary metal. Most of the buying and storing and holding of gold is done as a monetary asset by central banks and sovereign wealth funds. Okay, let's see. Today's close suggests good data will drop the market as it will drop rate cut expectations. Maybe in the short term. I mean, obviously there's algorithms that trade off of news and economic data releases. I would not anticipate. I anticipate that 2026 will be marked by much easier monetary policy and fiscal policy, financial conditions across the board, regardless of the week to week or month to month economic data sets that come out. Let's see. What do you think of Robinhood and Coinbase stocks? Okay. So typically when investing, it's this is one of those things where it's like the more you study the best traders and investors throughout history, the more you kind of recognize patterns and similarities between them. And one of the things that is common across all the greats is being able to separate emotion from investing and trading. Emotion is that part of our brain that is wired for survival, and it is not wired for making intelligent, long-term investment and capital allocation decisions. Um, and so I fully admit that my emotional bias about these 2 companies has influenced my my, investment decisions about them. Just wanna put that disclaimer out there. I do not like these 2 companies, um, for different reasons. So, Coinbase, I do not like because of decisions that they have made in the past with locking down people's accounts, with preventing certain types of trading during certain market conditions, um, with seemingly pumping, uh, I would say known scams, um, especially considering the views that the leadership has about things like Bitcoin. It's like they should have known better type of thing. So I'm not a big fan of the company in general. And so because of that, I don't like to invest in companies where I don't like the product or I don't like the leadership for reasons, specific reasons like that. It's the same reason why I tend to not invest in certain healthcare companies or like tobacco companies. Not and it's because ultimately I think over the long term, the goal with investing is wealth creation. It's maximizing your long-term wealth. That is the only goal. Um, and I think that when companies participate in things like that, it is a signal that they may be exploiting certain things in the short term and sacrificing long term, sacrificing reputation, that sort of thing that could severely negatively impact long term growth. Same thing with Robinhood. The Robinhood came on the scene with zero commission trading. They were, kind of the pioneer and pushed the entire industry to change. I think that is a good thing. But the way that they actually made their money, especially in the beginning, I think was very shady in terms of selling order flow, so that funds could front run all the trading. For somebody who's trading with $1,000 account, that doesn't matter at all if you get a worse fill. A 1 cent or a 2 cent difference on your fill doesn't matter to you. But for anybody who has a decent sized account, your execution quality in terms of getting order improvement on your orders, getting fills on limit orders that you wouldn't have gotten otherwise, or getting better fills on your market orders where you get a 1 cent or a 2 cent price improvement on your execution. That matters far more than a commission does. And it's still industry standard. Like you go to certain places, they'll give you a lot better order flow, like even like Interactive Brokers and Fidelity and Schwab. Those will give you order execution improvement where you'll save, 20, $100, $200, depending on the size of your order. Um, both on both sides, the buy and the sell. Whereas places like Robinhood make all their money, and a lot of other places do as well. It's not I'm not just picking on Robinhood here, but um, they sell that order flow and they pocket the difference from the market maker kickbacks. On top of that, shady stuff, locking down people's accounts, not letting them trade during times where it could have put their backers out of business, like the GameStop short squeeze, that sort of thing. So I do not like those types of companies. Um, who do stuff like that, um, because I think that that will negatively impact the ability of the company. They're exploiting things in the short term, that not really good business practices for the long term. Okay. For all the extra comments about silver, I've got a silver video coming out tomorrow. Short term, the long term I'm bullish. Short term I'm bearish. Um, what do you think happened to the so-called Santa Claus rally? Well, if you look at the S&P 500 from December 1st through just now, we ended the month up 0.4%. If you look from from November 20th, we're up 4.5%. Um, if you measure from, let's see, the top in October, let's say that was October 29th, you're down 1%. So, I mean, depending on when you expected the Santa Claus rally to happen, to start and to end, I mean, there were a couple rallies over the last couple of months, but there are also a couple big spikes in volatility. I do see, technically speaking, a few big risks forming in the market right now for the short term. Um, and so cautiously hedging here is something that I'm slowly, building into my portfolio over the last couple of days and will continue to over the next couple of days. But I still think the setup is bullish going into the beginning of 2026, and I'm still net long. Let's see here. What do you think of? Oh no, we already talked about that. Think about John. What do you think about John AG, the Asian guy? I find myself listening. I don't know him. I might have seen his stuff. I just don't recognize the name. Let's see. All right. Why? Okay, this one's from One's Nature. Why is there a difference between physical silver price and COMEX silver futures? Good question. Okay, so imagine you have a bunch of silver in your safe at home, and you want to use, and let's say you've got like $10,000 worth of silver in your safe, and you want to use that to buy a car that is, let's just say it's across the country. You live in California, and, this car is in, I don't know, Florida, and you want to buy this car. Um, think about logistically the cost of making that transaction. You could, in order, not even just like picking up the car for delivery. I'm talking about sending the payment. Um, so you could think, okay, well, I will load it up onto into a semi truck with a shipping company that is already going out there. And I'll just have to pay for the weight and the space in order to ship it out there. And maybe that'll cost you, I don't know, I'm just pulling these numbers out of thin air, so this is not real. But let's just say it'll cost you $500, and I only say that because if you're going to ship a car that distance, it'll probably be like $1,200 to $1,500. So I'm just thinking about the weight there, in silver. Maybe it's a couple $100. And you're like, okay, well, I don't really want to pay that. So maybe I'll drive out there. And then you're calculating the cost of gas and the wear and tear on your car. And you're like, okay, well, that's might be even, the same amount or maybe even a little bit more, because you're not splitting that cost with, a bunch of other people who are already shipping that same direction. So then you think about getting on a plane flight. And then you're like, okay, well, no, because of the weight. So no matter which way you slice it, you're going to have to pay a significant amount of money in order to deliver that silver somewhere else. So you're like, okay, well, then maybe that's not worth it, because then that cuts down the purchasing power of that silver for me. So instead, what I'll do is I'll just sell the silver and then make the cash payment through, a wire or, something like that. Well, then you go around and you look at actually selling the silver, and you're like, okay, well, if I go to a little silver, a metals dealer near me, right now the spot price of silver is $71 an ounce, but they're only going to give me $65 an ounce. And it's because in order to pay for the storage of that and the security, and then to be able to make a profit when they go to sell it about a little bit above spot, they have to be able to buy silver below spot in order to make that transaction worth it to them. And you get the same story at every single silver dealer or gold dealer you go to. Nobody will give you spot for it. They're going to pay you a little bit under. So then you're thinking, okay, well, like really, then you can't just look at the spot price. You have to take into account all the extra costs along the way. That means that when you're just trading on expectations of the raw price moving up and down, you don't have to really take into consideration all of the logistics of actual physical delivery and transferring and storage costs of that silver along the way. A little bit of that is built into futures, but really not much. Um, because most of that is not actually held for delivery. It's closed out prior to delivery. But physical markets, you have to take all that into account. And so that is the main reason why you see differences between physical markets and paper markets, because in reality, they are actually different. And there are costs associated with physical markets that are not associated with paper markets. Oil stocks might be good for next year. I do think there's some good oil stocks. ExxonMobil, I think, just hit an all-time high or very close to it. I'm long ExxonMobil. All right, from Jose Lavilla. What do you think will happen before Nvidia results in February? I don't know. I don't really have a strong opinion on NVIDIA. I don't have a position either way. And by the way, when I tell you guys what my positioning is, it's not a recommendation for you to take a similar position. It's because I want you to know what my bias is. So there's two kind of camps on this. A lot of people think, okay, well, I can only trust the opinion of somebody who's unbiased because then I'm just getting their raw analysis. And so that's like talking heads on CNBC, Jim Cramer, that kind of thing. It's like, I'm just going to share my opinions, and I have no position here that is influencing what I'm saying. The pros to that are, yeah, obviously there's not going to be a bias there from talking your book, but at the same time, you don't have any skin in the game. The downside there is like, how much do you trust that this analysis is um, well thought out and really authentic when they don't even believe it enough to put their money where their mouth is. And so what I tend to do is I lean the other way, which is if I have an opinion about something, I will tell you whether I have a position that way or not, because I think that while I am talking my book, it's also putting your money where your mouth is. It's like you know that this opinion of mine is actually a real opinion of mine because I have a position that corresponds with that opinion. Like I was talking about silver earlier, my long-term silver position hasn't changed. I'm still net long, but I have a short-term put position on SLV because that's what I think is likely to correspond with reality. And so if I didn't have a position, then I wouldn't have a strong enough opinion there. Or I that wouldn't be as strong as of an opinion as one that I do have a position on. And so with Nvidia, I don't have a strong enough position on it, strong enough opinion on it to have a position. Either way, I'm not long or short. I wouldn't be surprised if it continues moving up. A lot of people are just like their mind is it's hard to wrap your mind around a company that is worth $4.5 trillion, their market cap, but valuation wise, they're nowhere near um, some of the extreme valuations that we see other places in the market. Um, and so the market cap there is somewhat justified by the financials. Not fully, but somewhat. All right. Let's see here from Bradley. What does crypto do in 2026? Not talking about meme coins. I don't have any opinions on any cryptocurrency other than Bitcoin. Long term, I'm bullish on Bitcoin. I think it can definitely go lower. It seems like there's still a coordinated, um, I would say some sort of like a coordinated attack in order to try and increase the shorts and increase the selling and drive down the price to try and get some of the levered longs to turn into forced sellers, specifically like MicroStrategy. We'll see if they're able to do that. If they can, then MicroStrategy is going much lower and Bitcoin is going much lower. And then everybody doing this is going to be able to close out their shorts at big profits and then switch over to longs and get Bitcoin at a very, very, very attractive price. But we'll see if that's able to happen or not. My guess would be it's not able to happen, and 2026 we'll see higher Bitcoin prices. All right, let's see. All right, Bitcoin Broccoli, thank you so much for the super chat. I appreciate it. Always look forward to these. Happy New Year, and Happy New Year to you as well. Glad you look forward to these. I'll keep on doing them as long as you guys keep on enjoying them. All right. Question from Splat 752. If emotion is undesirable in trading, does that mean we should all prefer algorithm trading? Well, two things. Number one, you algorithms are just the automated execution of human decisions. So just because you have, let's say you've written a program for yourself to do some algorithmic trading, you're still choosing what those trading decisions, how those trading decisions are being made. And so on one hand, it's like, yes, um, the more you can remove emotion from that decision making, the better it will be. And sometimes that's just automating automating those things so that you're not changing your decisions while the position is open. This is one of the reasons why I always preach that you should have an exit picked out both on the upside and the downside before you ever enter a position. Because number one, if you don't have an exit decided on ahead of time, you won't know when it's time to get out. It's like you just think, okay, well, this is going to go, I'm going to buy this because I think it's going to go up. But it's like, how much do you think it's going to go up? Do you think it's going to go up 10% or 20% or 50%? Um, how do you know then, if you haven't figured that part out, how do you know whether this is worth the opportunity cost? Because you're putting your money in this instead of everything else you could be putting your money into. So how do you know that this one is worth it instead of something else? And so you have to know what your potential upside is on any investment. Otherwise, you don't know whether it's actually worth making that choice. Second, you have to know where you're going to get out on the downside. Like, what if you're wrong? What is going to be the decision making factor that will have you get out? If you don't know that, then again, you won't know once it starts falling whether you should be getting out or buying more or doing nothing. Um, and so you have to make those decisions ahead of time, which removes your emotion, because once your money is on the line, your emotion takes over. And so if you haven't chosen those two things before you actually enter the position, once you enter the position, you won't be able to make those decisions rationally. You'll be making them purely on emotion, which increases the likelihood that you will be making a bad decision. And so the more you can remove emotion from that, the more likely you will be able to make good trading or investing decisions. And one way to do that is to just make the decisions before you actually open up the position. And another way to do that is, is through having computers do it for you. Now, I will say that that is a pretty difficult thing to do, to have computers make those, unless you're just talking about just the simple stuff like stop orders and trailing stops and limit orders and things like that. That's very, very easy, obviously. But if you're talking about like a trading program, a bot that will be trading for you based on specific parameters, you still have to make those decisions about how it's going to be trading for you. And you have to make changes to that along the way as you figure out what works and what doesn't work. That takes time, that takes money, that takes patience. And you're playing a game that there's a lot of bigger money and a lot of smarter people playing directly against you in that game. So, is it possible? Yes. Is it easy? Not by a long shot. All right. We've heard a lot of buzz around gold hitting 10K in 2026. Do you see this as probable? And if so, what are you seeing conditions coming up that could be conducive to this? I don't think so. I mean, honestly, I would be surprised if we see gold above 5,000 in 2026. I think most of the big run has happened. I more anticipate sideways volatile price action rather than a continued bull market here. I could be wrong, and it's not like I'm selling my gold or for the most part, I'm not even trading it in my trading, opening up and closing trading positions on it in my trading account. I just don't think that, gold tends to anticipate monetary policy changes. And then once those changes that were anticipated start coming into effect, most of the movement has already happened. And then gold starts to price in the next big change after that. So I don't anticipate, I would be surprised if gold got above and stayed above 5,000 in 2026. But I could be wrong, and if it happens, I'll be richer, so I won't be mad. All right, let's see here. $75 billion bailout repo facility, maybe. Okay, so end of months and end of quarters, you tend to see spikes in repo usage. This is called window dressing because banks want to have extra cash on hand for their reporting. That's all this is. Every single, when liquidity is tight in the system, every single end of quarter and many end of months, you see the exact same thing happen. This is the reason why the Federal Reserve started not QE recently, is because liquidity is tight in the system. And so they are purchasing T bills and treasuries up to 3 years in maturity in order to take the collateral off the market and inject cash into the market, help increase bank reserves. So it's been well known that liquidity is tight, but the existence of the repo market, the standing repo facility at the Fed, means that that is not and cannot be an issue because banks can get all the liquidity they need directly from the Fed. This is a change that they made in 2021 or 2022, um, and is to serve the exact function that it's serving right now, which is if liquidity conditions get tight, then banks can still get the cash that they need directly from the Fed. And at quarter end, especially at year end, you see that spike every single time. All right, let's see. Question from One Buys. Yo, my guy, what's your take on Bitcoin? I have really heard you comment on that asset yet. I do talk about Bitcoin quite a bit, especially on these live streams because the questions come up. I don't make videos about Bitcoin very often because when I do, for some reason, they don't perform well. And I've just taken that to mean that the people who tend to watch my videos don't tend to like Bitcoin. So, but I did post a video recently about Bitcoin within the last couple of weeks about MicroStrategy and Bitcoin falling in price. I like Bitcoin. I think a 5% starting allocation to Bitcoin and then never selling and dollar cost averaging 5% of your future investments into it. And again, never selling. That's an asymmetric bet. I think the way that it is designed has caused it to organically grow to the point where it is today because it is characteristically uh, a very functional and highly effective form of money. Um, and I think that that means that the chances that it becomes used as money universally, globally in the future are high enough where I think a decent allocation like that is worth it. Because if it does become used as money everywhere, the value relative to everything else must be much, much, much higher than it is today. If it doesn't and it goes to zero, I lose 5%. And so it's an asymmetric bet at this point. And even at the price point that it's at today, it's still an asymmetric bet. So I am a fan, but I just caution people who put, 20%, 30%, 50%, 100% of their net worth into it because it's like, man, you're risking financial ruin at that point. And I don't think that is a risk worth taking. Okay, Heresy Financial from Stefan Wolf. Are you a fan of any college football team? Man, I hate to say it, but I'm really not a huge fan of sports. Um, I played sports in high school, played football, I wrestled. Um, I've just never been a fan of watching them. And my my wife's whole family, they're very into every sport. If there's a score being kept, it's a fun thing to watch and track and be involved with. So a little bit of an odd man out here. But yeah, I personally don't find that much enjoyment in sports at all. Maybe because just characteristically, I'm pretty competitive, and if I'm mentally involved in something where I feel like there's winning and losing, but I don't have any control over it. It's just not. It's frustrating to me. Like I don't want to get emotionally invested into something that I'll feel like I won or I'll feel like I lost when I didn't have any control over over the outcome at all. And when I do have some control over the outcome, then I get very, very competitive, and I really, 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 really hate losing, and I really like winning. And so that probably has something to do with it, but I'm not sure. Um, okay, let's see. By the way, guys, for anybody who just hopped on, I'm trying to answer as many questions as come in from you guys. If you tag me in the comment, the with the question, it'll be easier for me to see it. I might not see it as I'm scrolling through if you don't tag me. All right, comment from Whiskey Romeo Bravo super chat. Thank you so much for the super chat. I do appreciate that a lot. Thoughts on gold in 2026? Where is it going and why? My best estimation of what I think gold is going to do this coming year is volatile and sideways. I think it will be. I think we'll see some ups and some downs, but overall, when you look at what gold tends to do, when you look at gold, gold's chart over the past, I would say 15 years, you notice a big spike that precedes monetary policy. And then once that monetary policy really starts to happen, then you see just kind of sideways action for years until it starts to price in the next big movement. And so you saw the same thing in like 2019. It exploded out of its long-term rectangle range above long-term resistance once it started to price in the fact that the Fed was going to have to restart QE. And then obviously 2020 happened and it really exploded from there. But it topped in July of 2020 and the money printer had barely even started then at that point, but gold had already made its move. And then it started, moving sideways basically in anticipation of the tightening that was coming. Once the tightening was fully priced in, started happening, then it started to price in the future easing that was going to happen. And it broke out again in February of 2024. So for the past 2 years, approximately, it's been moving upward and it's up over 100% in that period of time in anticipation of the next easing cycle, which is now starting with not QE, interest rates going down. And now that easier monetary policy is here, my expectation is that gold has anticipated that again already, and we'll start to see some more sideways action out of gold because the move has already taken place. Gold tends to front run that stuff. Okay, let's see here. Next question. From Mr. Luigi of the Hood. Thank you so much for the super chat. I appreciate it. You said, I appreciate your clear and concise explanations. Love your content. Learned so much, especially on the reverse repo activities. Happy New Year, everyone. Well, not even a question there, but I do appreciate the comment there and glad that you are enjoying it. I'll continue to do this stuff as long as you guys to keep on enjoying it. Next one from Grumpa5798. Thank you again for the super chat. If I go short 3x levered on oil, will this deter Sean Combs P. Diddy from targeting me? Probably not. I don't think that'll offer you much protection. And also going short 3x levered oil funds that might actually open yourself up to getting targeted in a different way. Some financial torment. We'll see though. All right. Do you still use One Gold? Yes. My favorite way to use companies like One Gold, Vaulted is another one that I like, is you use it to accumulate a stack of metal. Once you get to a point where you have too much, where you're like, I don't want this just sitting in a vault. I don't want paper gold anymore. I don't want ownership of gold sitting somewhere, or silver, platinum, or whatever you're doing with it. Once you get to a significant number of ounces, you just request physical delivery at that point and you start over. If you're buying physical at like a tenth of an ounce or a half an ounce or even 1 ounce at a time, usually you're paying way too much. It's just too expensive. Again, the cost of delivery, the insurance, the shipping, the weight, all of that. It's just, you're paying way too much per ounce. It's not cost efficient. And many times, especially like with silver, you have to see sometimes a 30, 40, 50% increase in the cost or the spot price just to be able to break even on it. It's not worth it. But it is worth it if you can stack it up, allocated, segregated gold in a vault or silver in a vault or platinum in a vault. You stack it up. And then once you have 5, 10, 15, 20 ounces, you're like, okay, well, this is a significant chunk of change. I don't like the risk of not having it personally. Then get it physically delivered, and the cost per ounce is way smaller as a percentage. And so that's what I like using those services for. Let's see. One Gold is just at Mix. You get a better price at Summit Metals. For the physical delivery side, yes. But at Mix, as far as I'm aware, doesn't have like the easy like storage service where you're like, hey, I'm gonna put $25 a week in, or something like that. So I like using those services when you don't have enough to buy big chunks at a time. You just want to stack every week or every couple of weeks or every month. Um, and then if you don't like the delivery prices through there, just sell it through there and you get basically the spot price or a lot closer to it. And then you take that cash and you buy it for physical delivery from somebody else. Um, let's see. I see the affordability crisis also applies to your trading group fees from Willem. Yeah. So why do I charge so much for my investment research service, my trading program? Basically, all I'm doing there is showing you guys my trades. I'm sending out the information, the tickers, the prices, the targets, the exits, the alerts of what I'm doing. I found a long time ago it was like that was something people were very interested in. It's become my, flagship product, the thing that people are most interested in getting from me, basically because my performance over the last couple of years is very good, so people want to follow along with that. Why do I charge so much for that though, when I could have a lot more people enrolled by charging less? Well, when I started, I actually did charge a lot less for it. And what I found was a lot of people joined who shouldn't have joined. And what I mean by that is if you have $10,000 to invest, $20,000 to your name, and you're making $25 an hour, $40 an hour, um, there are other things that you need to do financially before you begin actively investing. It's just not something that will be of service to you long term to try and actively invest at that point. Um, if you increase your returns from 10% to 20% to 30% annually overall by spending a lot of time actively investing, it doesn't it doesn't make a difference to you if all you have is 10 grand. Um, you should be spending every single ounce of time and energy and money that you have on increasing your income and your earning potential to go from making 100 grand a year to 200 grand a year to 300 grand a year so that you can start plowing 5,000, 10,000, $20,000 per month into your investment accounts. Once you're at that point and you're investing a significant amount of money, then it makes sense to start trying to invest it well. But it does not make any sense when you're first starting out, when you have low income and we have a small account to try and worry about your returns. Put it in an index fund and don't think about it. Worry about increasing your income potential. That is by far the number one driver that will contribute to your overall long-term wealth. And so, um, and so I found that when I priced it low enough where basically anybody who wanted could join, um, there were far too many people who joined that I was like, after seeing some of the things that they would say, it's like, you should not be doing this. Like you don't have the time, you don't have the income, you don't have the ability to, have the drawdowns and the volatility. And it's just like, you shouldn't be a part of this. And so raising the price filtered out the people that should not be using it, to the point where it's like if the cost, which is for each of my programs, just so you know, is 3 grand a year. I have a couple different programs. If that is something that's like, oh man, that's a stretch or that's too expensive, it's like, if that's the case, you're right. You should not be joining. And again, it's not because I don't want to help people who don't have money or don't have wealth or don't have income. It's that the reason why I spend hours a day on doing live streams and making YouTube videos and tweeting and putting out my free content, my free courses, all the stuff that I do. It's like I'm trying to get you to that point where a couple $1,000s a year is really nothing to you, because then it's worth it. Then it's like the stuff that you're going to get there, and it's actually going to make a big difference for you. Um, so all the free stuff that I put out is to help everybody who can't afford to spend any money get them to that point. And once you can, and that's not a big deal anymore, then it's actually going to be helpful. So anyway, okay, next question. Um, did I hit the one from? Yeah, I did. Okay. From Ounces app. Thank you for the super chat. Appreciate it. What are your thoughts on platinum at current levels? It's extremely undervalued against both gold and silver on a historical ratio basis. Okay. Two comments about that question. Number one, ignore historical ratio bases for anything between any metals. There is no inherent relationship between the relative value of coffee and beef. There is no inherent relationship between the relative value of orange juice and sugar. There's, well, okay, maybe that one, because they do use sugar as an ingredient in orange juice a lot of times. So the demand for one can influence the other. Um, but there's no inherent relationship between the relative value of metals either. Um, and when I say inherent, I mean in the metal itself. So just because the historical ratio between gold and silver was 15-1 for a long time, that has no bearing on today. Why? Number one, because that ratio was held by law for many, 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 many decades, if not centuries. And that ratio changed, but it was held by law. So right away there, it's like, okay, well, you have to throw all that out because it's just the government declaring that value ratio. Excuse me, that value ratio. It has no influence from the free market or from the physical world. Once that no longer happened, you saw that ratio immediately spike, and it's always been extremely volatile. And then you say, okay, well, there is a relationship there inherently because of the use case between them is similar. It's like, yeah, it used to be silver was used as change for gold. So it was like copper was used as change because they were less valuable metals. And so instead of trying to cut an ounce of gold in half, you pay with a couple ounces of silver or copper. And so it operates like change does for large dollar bills. That makes sense. But the reality is that relationship has been on the decline for hundreds of years because of the invention of paper. Once gold started accumulating in the vaults and the ownership of gold started trading hands as payment instead of the physical gold moving physical locations as payment, the need for change, in other words, silver or copper, for that goes way down because now I can transfer any amount of gold in terms of the ownership of that gold by a different piece of paper. So if I've got 100 ounces of gold in the vault, I can move 1/10 of an ounce of that gold from my ownership to somebody else's ownership with a simple piece of paper. And so it eliminates the need for things like silver and copper. So the invention of paper as redeemable money started the process of demonetizing metals other than gold. So, that relationship, that ratio, there's no world in which you should be paying attention to that as an investment indicator. Now, does that mean that that ratio will not improve? No. In fact, it could flip. It could, at some point, silver could become more valuable per ounce than gold. And so the bottom line is that the ratio itself has no inherent or necessary influence on the relative values of the metals. And it's the same thing with platinum. That being said, I am bullish on platinum. We have one of the largest uh, wedges that I've ever seen in platinum over the last, let's see, it started back in 99. So for the last 25, 26 years, we've seen a rising trend line at the bottom of the price of platinum, and we've seen sorry, there's something flying around my face, little gnat. We've seen a falling trend line at the top since like 2008, and we broke out from that wedge, that triangle, in May of this year, 2025. And we are now just recently at the top for platinum that we were at around 2008. And so we did very briefly break above that and have come back down to kind of retest that. So when you see those kind of movements, it's like we have a lot higher to go, but these moves take so much time to play out. And so long term, yes, I'm bullish. Short term, I would not be surprised at all to see a lot more volatility or a bigger crash before the bull market resumes. Okay. Next question from Emmanuel 4390. Thank you so much for the super chat. I do appreciate it. Is there a way for us to calculate real inflation? Does the government actually borrow at a rate lower than inflation? If so, does buying bonds or T-bills lose you money to inflation? Fantastic questions. Love it. So unfortunately, this is going to be a little bit of a longer answer just because I really like this question. So, um, is there a way for us to calculate real inflation? Uh, there are better ways to calculate inflation, but no real way to actually measure complete inflation. And the reason why, there's a couple reasons why. So number one, in price changes influence human behavior. So if the price of beef, let's say, triples, and your ground beef, you were paying $8 a pound, $8 to $10 a pound because you were getting the organic stuff, um, and it goes up to $30 a pound, you might be like, you know what? Ground chicken is looking pretty good. So you might go and get some ground chicken for, I don't know what ground chicken is going for these days because I don't buy it, but let's say it's, I don't know, $4 or $3 a pound. I assume it's cheaper. Because you're going to say, okay, well, that's $10 cheaper. Well, the prices were rising as a result of supply and demand, and whether that demand was increasing because of money printing or whatever, it's still people were willing to pay more and more and more for it, and sellers were able to get more and more and more for it until it got to 30. Then behavior changed and people started buying something else instead, which took away some of that future demand and started plowing it into chicken instead, which stopped the prices going up. And so the problem there is that you would say, okay, well, inflation then ceased. The problem with that is that that money then went somewhere else and maybe started bidding up those prices a little bit too. But even if it didn't, the quality of life went down because people would have preferred to continue to buy beef, but because they couldn't afford it, they switched to chicken. So they got something they wanted less instead of something that they wanted more. And so because behavior gets changed as a result of behavior changing prices, you cannot fully capture that by just measuring prices because those price changes inherently will stop when behavior then gets changed as a result. And the reason why that matters is because inflation and deflation at the end of the day are just measurements of the cost of the quality of life that people prefer. And so throughout the course of history, as we have innovations and inventions and progress and growth, what we are actually seeing is deflation. We're seeing the ability to get more for less. It costs less human labor to get the same or more of something that humans want and need. Today, it costs very little human labor to get food and shelter and clothing and luxury and entertainment compared to 500 years ago, 1,000 years ago, 2,000 years ago. So there's been deflation because we get a lot more for the same level of human labor, or even a lot less human labor. And so that is deflation. We get more for less. The problem is when you try and measure that, there's always going to be a breakdown in that measurement because human behavior changes when prices change. And that's the same with inflation and with deflation. So we can't really in total calculate it. The other thing is that you can get a lot closer than like the CPI with private measures of inflation. So there's old ones like I don't know, the Chapwood Index and Shadow Stats, and there's some ones that will measure inflation differently, and those tend to overestimate what inflation is because you do have to make changes. Like the CPI makes changes, you do have to do that because like the things that were included in the CPI 20, 30 years ago are irrelevant because people aren't buying them today. So you do have to make some changes. So the question is like, how much are you changing what you're measuring, and are you overdoing it or underdoing it? Because like today people don't buy standalone radios and stereo systems and sewing machines. And, people buy sewing machines, just not as much as, they used to. Um, and, it used to be like your clothes were like a lot of your labor throughout the year went towards making a lot of labor around the world went towards making and producing and affording just regular clothes. Like textiles was like the biggest or one of the biggest industries for like most of human history. And only relatively recently has it gotten to the point where we have machines that can do it so cheaply and efficiently that clothing is like it's super cheap now. Like you don't have to think about it. You don't have to wear one shirt every day all year long. Like it's just not a thing anymore, which is great. That is a huge advancement in human wealth. Um, but that means that you have to change the way that you're measuring inflation because the things that people tend to buy changes. One way that I like to measure inflation is by looking at the price of gold. Like, what can I buy with an ounce of gold? That tends to be a pretty good measure of real purchasing power. Over time, when you look at like the cost of employing an army captain today, in gold. It's very similar to the cost of a Roman centurion, which was a similar job 2,000 years ago. And so it does a very good job of maintaining its purchasing power for things that haven't yet gotten cheaper due to technology. And then things that do get cheaper due to technology, like food and clothing, that shows up in the price per ounce of gold as well. So that's one way that I like to measure like real inflation, which means when you're looking at gold, you're not making money when it goes up. You're just preserving your purchasing power. It's just like a savings account. Um, that also means that the second part of your question, Emmanuel, is that the government does borrow at a rate lower than the rate of inflation because as the dollar loses purchasing power, they're borrowing money today and they're paying it back in 2 years, 5 years, 10 years, 30 years. And so if the dollar loses purchasing power at a rate that is larger than the interest rate that's being paid on those bonds, then the government is borrowing at a negative real interest rate. And when you look at government bonds, like the 10-year yield over the past 100 years, um, when you adjust it for the official inflation rate, not even like what we think is probably the real inflation rate, but just the official inflation rate, most of the time, the vast majority of the time, the 10-year yield is below that, which means the vast majority of the time, the government borrows at a rate lower than the rate of inflation, which means they're borrowing money that is worth more than the money that they are paying back in terms of how much stuff it can buy. And that does mean if you are the lender that you are losing on that. If you are the one buying those bonds, then you are the one who is getting the raw end of that deal. You are losing purchasing power even when accounting for the interest. Now, that doesn't mean that everybody who buys bonds is losing because banks buy bonds, but they're not just doing it with like their own cash. It's a leverage play. So they borrow money from you and they lend it to the US government. So they're getting, 3%, 4% from the government and they're paying you 0.1%. They're keeping the spread. So they'll do that play all day long because they're not just taking their dollars, they're doing that with leverage. So all they care about is the difference between what they have to pay on the money they're borrowing versus what they get paid with what they buy with that money. And so they'll buy government bonds all day long because the straight up return on those bonds doesn't matter. It's just the spread that matters to them. Um, that also means that if you have your money in your cash in a checking account, in a savings account, in a money market fund, in a brokerage account, in an IRA, in a 401k, if you have cash in the system at all, as long as it's not physical under your bed, you are an indirect lender to the US government. And whoever is using your money to lend to them is collecting that instead of you. Okay. Let's see. Next question here from above my pay grade. Thank you so much for the super chat. I do appreciate it. Would you give different investing advice to someone with a federal pension? Ooh, good question. So, federal pension, I would just put a pension in this category. Um, because a pension, all it is, you're looking at a fixed income. So you're collecting a paycheck, and you have a good idea of what that paycheck will be into the future. Um, I don't think there are many private pensions left today, but there are quite a few people who are living on government pensions. I don't think there's a huge risk with pensions stopping payouts, especially government ones, because at the end of the day, the government has a monopoly on violence, and they will do what they need to do in order to get the money to pay out the pensions, because the people who are collecting on those have very, very big influence in on who's in power. And so I think it's a fairly decent, fairly reliable source of income. Now, do I think that the increase in your pension will be equal to the real rate of inflation? No. And so when you factor in the purchasing power of that, like if you're looking at, okay, um, I'm going to expect that the purchasing power of this will decline by a certain amount per year because I think the cost of things will go up from money printing, but my pension will increase at that exact same rate. It'll increase, but not quite as much. Um, I think that's something that you should definitely be factoring in, which means you're going to have to invest in another way in order to compensate for that. And so that's just like, hey, there's some income that I can rely on for my overall calculation. And so then the next step for that is, okay, well, how much income do I need to live? And maybe your pension is going to pay you $2,000 per month, and you, let's say you need $10,000 per month in today's purchasing power to be able to retire. All you're going to need to do is go to a basic retirement calculator and see what you're going to need to produce the difference, that $8,000 per month. And we're going to do it per year. So you're going to do 8,000 times 12 for the 12 months in the year. So you need income of $96,000 per year in order to be able to retire. $96,000 per year. You now need to figure out, okay, what is the total portfolio value that will produce that much reliably for the next, for the rest of my life. So $96,000 per year. The safest and easiest way to do this is just to divide that number, 96,000, by 0.04. Because that's you saying I'm going to take 4% of my portfolio, and I need that 4% to be $96,000. So if you need 4% of your portfolio to be $96,000, you take 96,000 divided by 0.04, and that spits you out $2.4 million. So you need a portfolio that's worth $2.4 million in order to give you enough income on top of your pension, if your pension is $2,000, in order to produce the $10,000 per month that you need. And that 4% means that, some years you're going to be pulling from it when it's a down year, but ultimately you can expect with a well-diversified portfolio, it will produce more than 4%. So you can reliably pull 4% every single year and not have to worry about that account ever running out. If you want to be more aggressive, you can do a higher amount that you're pulling, and then you need a lower amount in your portfolio. And maybe you just run the risk of running out sooner, or having to decrease the amount you're taking. But then once you have that final number of what you need, but in this case, $2.4 million, then you say, okay, well, when do I need it by? And the shorter amount of time that you have to get there, the more you have to invest every year. So if you need that $2.4 million by next year, well, guess what? In 1 year, you're going to have to invest $2.4 million. But if you need that in 10 years, well, then you're going to probably need to put in like $200,000 per year into your investment to be left with $2.4 million by the end of that, because there's some of that is going to come from growth. The longer the time frame you have, the less money you have to invest each year in order to get to that point. So really, a lot of this is just a math problem. And when you do break it down by what you want or what you need, typically the number that you end up with is not that it's encouraging, because it seems like it's achievable. So I encourage you guys to do those calculations yourself. Next question from the Chronicles of Cody. Thank you so much for the super chat. I do appreciate it. Do you use any AI tool like Grok or Copilot in your business, admin, operations, analysis? I am trying. I think probably like most people who are not programmers, you have this sense of like, oh man, I should be using AI more. And you just haven't found a really good use for it yet. So I am continuing to try and use it more. I do use it for specific, like, because I don't know how to program or code. So when I do have a need for that, usually I'll just do it with Grok or sometimes Chat GPT. I haven't tried out Claude yet, because I'm not a programmer, so I don't need something that's built into, the whole, like, I don't even know what it's called. the program that you use to do your coding. So what I'll do is I'll just tell it what I need, and I'll say, "Give me the code. Here's the specific requirements for, it has to be written with these languages and that sort of thing." And it'll spit something out for me. I'll copy and paste it, and if it works, then great. If it doesn't work, then I'll go back and say, "Hey, this isn't working. Tell me why. Here's the error that I got or whatever." And so I'll usually, it takes a couple of tries, and then I'll figure it out. And that's kind of the extent for business purposes that I've been able to figure out a good use for it. Um, but I'm continually trying. It'll probably get to a point where it'll be um, a lot more embedded in kind of everything. But at this point, I haven't found too many super useful uses for it, other than just some basic, like, for right now, my favorite thing to use it for is just very basic learning. So like if there's like a topic that I'm like, okay, where do I start here? Explain this to me very simply, give me the breakdown, point me to some areas where I could do some deeper research on this, provide the evidence, back it up. Like I'll ask it clarifying questions about those topics, like, hey, you said this, but I don't understand this, like it seems like this contradicts something else. And I'll do the exact same thing with multiple. So I'll use, Gemini and ChatGPT and Grok, and I'll do the exact same conversations with all of them. And if they all kind of do the same thing and give me the same answers and responses and information, then I'll kind of get it, have a good idea. But if I get different, then it's like, okay, well, what's it helps me kind of identify if there's, mistakes being made, or if there's just hallucinations, or somebody's making something up. All right. Next one from Brando GTR48. Thank you so much for the super chat. I appreciate it. Thoughts on buying mid and small cap ETFs now while large cap indices are overvalued? Um, I think it's always a good idea to have at least somewhat of a mix. Um, in terms of just looking specifically at, this market cap size is overvalued and this market cap size is not. Um, well, it depends on what you mean by overvalued. If you're looking at like the overall, like the PE ratio of the Russell 2000 versus the P ratio of the S&P 500, um, I wouldn't just look at the price ratios, the relative performance, because that doesn't really tell you much, because it's like, well, the performance of large caps is outperforming because they're like, at this point, potentially, or at least the market perceives it this way, that they're better companies and they have a better likelihood of performing well into the future. But I do like small caps right here. So I'm not trying to imply that I'm bearish on them. Um, I think it's always a good idea to have a mix, because you're never just going to have one asset class or one market cap size range that is always going to consistently outperform. All right, next super chat is from Mike6044. Thank you so much. I appreciate it. So Mike said the Fed has stopped QT and that they will likely reduce the Fed funds rate to zero to monetize the debt. Thoughts on incurring debt and investing it before this occurs? I don't think they're going to take the Fed funds rate to zero, actually. And they definitely have not said that they're going to do that. I think the Fed funds rate will continue to go lower from here, but I don't think they're going to take it all the way to zero. Um, in fact, I think the rate of inflation will start to increase well before they were ever able to get to zero, assuming they do quarter percent cuts each time. Um, Now they are already monetizing the debt through their new round of QE. So they're doing T-bills. They're buying T-bills and bonds that mature up to 3 years. And so they are expanding their balance sheet again. They're saying that this is not QE because the reason they're doing it is to make sure there's ample reserves in the banking system. But it doesn't matter the reason why they're doing it. They are removing assets and collateral from the system and replacing it with cash. That is monetizing the debt. So they are continuing to do that. That is easing. I think they're going to continue to take the Fed funds rate down. I think that'll push long-term rates up. Um, Now in terms of getting debt yourself and investing it before it occurs, kind of depends on what you're buying with it. So if you're like talking about like margin debt in order to purchase stocks, um, that doesn't necessarily help you because you still need the stocks to do well. Um, and it doesn't necessarily help you to get that beforehand, because just because the Fed funds rate goes down uh, doesn't necessarily by itself push stocks higher. Something like real estate that has a lot more of an impact. Um, but the Fed funds rate going down is not going to have a direct result on mortgage rates going down, especially because on their balance sheet, they're still selling mortgages. So the pressure the Fed is putting on the mortgage market is actually pushing up on interest rates. Um, and assuming that the market starts to price in that future inflation, then long-term interest rates and private market interest rates actually go up. And so could put you into a pickle for long-term debt that you might need to refinance, but rates have gone up for you, even if like the T-bill rates have gone down. Is that a Daria Kolosova painting of Monopoly Man and Scrooge McDuck behind you? Yes, it is. I've started seeing her work on online a couple years ago, and finally, I probably 6 months ago commissioned this piece from her. I call it Capitalism. She painted it for me. It's the Monopoly Man and Scrooge McDuck. They're playing poker together. With you see, there's some gold bars over there, and they're playing with cash right there. And he's got a Bitcoin pin on his lapel. It just represents everything about, free markets and business and entrepreneurship and investing. It's like you have to take risk. That's what the poker part means, that, you want to accumulate assets like Monopoly. You want to use debt judiciously like Monopoly. The bank can never run out of money like in Monopoly. Scrooge McDuck is the miser. He's the saver. And that is how you accumulate capital in order to invest. He's the unsung hero of the Christmas story, is that, the miser is actually a hero to an economy because they produce without exchanging their money for something of real value. As they store up that money, they're actually helping keep prices low because they're not ever, they're not ever redeeming that claim on real wealth. They're just producing without taking. Um, and then we've got the different forms of money that they're playing with. So anyway, lots of elements of capitalism that I like in that painting. Okay, let's see. The next question here from unknown YTX. If you had the opportunity to rent seek, government makes you pick as a winner, would you? Government makes pick you as a winner. I mean, I have the opportunity to rent seek. I mean, there are lots of opportunities to do that most people are not aware of. Like something as simple as uh, Section 8 real estate investing. At the end of the day, that's what that is. Your Section 8 investors, they're not exploiting the poor. The poor and the Section 8 investors are exploiting the taxpayer. That's where the money is coming from. And so the poor get to live rent free, and the investor gets a return on their investment far superior to anything in the free market, at the expense of the taxpayer. And you can get really, really good returns investing in Section 8 real estate. Again, far better than anything you can get in free markets, because it's paid for in a way to incentivize people to do that, because there's a huge wait list for Section 8 compared to the amount of houses that are available to people on Section 8 vouchers. And so they're paying at a way above market rate for those. And it's paid in a weird way. It's paid off of like the number of bedrooms and stuff. And um, so anyway, you can make a really obscene amount of money, return on your capital doing that. I don't do Section 8 because I don't think it should exist. I ran this poll on Twitter a couple of months ago where I asked people if they thought it was hypocritical if, number one, you think a government program should not exist, but number two, you are on the receiving end of money from that program. And I gave the examples in the poll of things like Section 8, food stamps, and Social Security. And so many people got really, really upset in the comments because they were saying like Social Security is not a handout because I had to pay into it my entire life. The problem with that though is that you didn't pay into anything. There's not like an investment pool that your money was invested in and you're getting the returns from that. Um, Social Security is just a transfer tax, just like every other payment from the government is a transfer tax. The government is just a wealth transfer tool where they take money from some and pay it back out to others. That's all the government does. And so you never paid into anything. The government took your money and handed it to somebody else. And now the government is taking somebody else's money and handing it to you. And so the my question, I don't think there is any other than an arbitrary line in the sand. You cannot draw a real distinction between any government payouts, whether it's Social Security or food stamps or Section 8 or anything. It is the government takes money from one person and hands it to another person. And I personally don't think that any of those programs should exist. I think that the rich have a moral obligation to take care of the poor, and it must be voluntary. Otherwise, it's theft. There's no way around it. And so I do personally give a lot to charity, even though the government takes a lot from me. Um, but I don't think that those programs should exist. And so because of that, I think that it's probably morally hypocritical for me to be on the receiving end of that. Like, how can I say Section 8 shouldn't exist, Social Security shouldn't exist, food stamps shouldn't exist, PPP loans shouldn't exist? Like, how can I say all these things shouldn't exist, but then position myself to be on the receiving end of it, to be receiving those benefits? And maybe it's not hypocritical because a lot of people say, well, you're just getting the money back that they've taken from you. But at the end of the day, that's the argument that every single person has made that puts them up the chain to being the one who is a net recipient rather than a net payer, or a net being taken from. It's just getting back what, it's going to go to somebody, might as well be me. It's like the reason why we're in the situation because everybody believes that and acts that way. And it's like there would be no government contracts being paid out. There would be none of these payout programs happening if everybody were to live the way that they thought that everybody else should be living. Um, and it's because of the idea, well, me just being me, not changing or, doing it, it's not going to change anything. So might as well. I think it's a moral cop out, morally hypocritical. Um, and I recognize that not everybody has the ability to do that. I recognize that it's because of my financial situation that I'm able to take that stand, which means I think it's even more important that I do, because it'd be even more hypocrite. Like if I was like destitute and I was like, had nothing and, had no saving, whatever. Like, it's like, well, I don't have a choice. Like maybe I don't think it should exist, but I will starve. Like I don't have a choice. Then, I can see the justification from that standpoint, but it's like, I, I think because I'm not in a position where I would need any of that, it makes it even um more important that I live the way that I think everybody should be living. So anyway, that's my opinion on it, and I know it's very controversial. It's not for nothing that I named this channel Heresy. That a lot of people view my opinions in a way that they think I'm a heretic, financially and in many other ways. So, okay, guys, I'm going to do one more question here, and then we'll end the stream for today. Let's see. Um, All right. If you guys have any last minute questions for me, throw those in the chat. It looks like there's a big looks like there's a big disagreement going on between people in the chat. Trying to find a last question here. Um All right, here's one. Will the caterpillar stash make my mustache? No, I every once in a while I'll bring it back. My family prefers when I don't have it. Um so I had the mustache for the Christmas week and then took it off again. By take it off, I mean trimmed it off. Staying in shape, no, it is not easy. I did the carnivore diet back in 2021 for a year, lost 50 pounds in 5 months, and then I stopped losing weight. And then I started to have issues with, not being able to really work out super hard in the gym. Um, I started having trouble with staying warm, like I was constantly cold, and so then I started adding fruits and vegetables back in. Um, when you don't eat any carbs whatsoever and you just eat meat, it's very easy to maintain the proper weight. I've only ever known one person who's been able to uh, get fatter on a pure meat diet. Um, and they were just able to force themselves past that mental block of, when they get full, they just kept on eating, which is very hard to do if the only thing you're eating is meat. Very, very, very difficult to overeat on meat. Not impossible though, because again, I know somebody who's able to do it. But it's a lot easier to overeat when you introduce carbs because just biologically, our body wants more carbs because in nature, carbs are scarce. Um, and so that does make it more difficult. I started in 2021. I started at 230 pounds. I'm 5'10" and 3/4. With shoes on, I'm 5'11". So I started at 230. I lost 50 pounds. So I got down to 180. Technically, I got down to 179. And I stopped losing weight. And then over the next couple of years, I slowly put on weight back up to 200 pounds. And a good amount of that was muscle. I was working out. I've been, since then I work out every single day. But I did put on some fluff from that. And so then earlier this year, I started a cut again, in about April of this year, and got down to 169 in September. I'm 175 now. Um, and that's a good holding weight for me. Right around 175 right now. Obviously, my goal is to continue to put on more muscle. That just requires working out a couple times a week, close to failure, out, every body part that you want to grow, um, and eating enough protein, which is the easiest way to do it is 1 gram of protein per ideal body weight. And you're gonna put on muscle. It's just very slow if you're natural. At this point, I have not taken like testosterone. I've done some peptides. So by some people's standards, I'm still natural, but I haven't done anything that's anabolic. And so my muscle gain is still slower at maybe 2 to 3 pounds a year. Um, but I'm getting pretty close to the point of going on TRT. I say TRT really would just be going on testosterone, a TRT level dose of testosterone, because I really probably don't need it. My total test, it fluctuates between like 700 and 900, and my free is usually around 11 to 15. So I don't necessarily need it, but man, the temptation to hop on a a TRT level dose haunts me every day. So, all right. Thank you guys. I really appreciate the questions, and happy new year. Have fun tonight. Stay safe, and see you next time.